Good morning. Welcome to Top of the Morning by Mint, your weekday newscast that brings you 5 major stories from the world of business. It's Monday, April 21st, 2025. This is Nelson John. Let's get started. The Nifty Bank is just 177 points shy of its all-time high, riding a 9% surge over the past month. Solid Q4 results from ICICI Bank and HDFC Bank have powered the index up, outperforming the broader market. And now, options traders are betting it'll stay in a tight 4% range this week. Based on the straddle sold on April 17th, the Nifty Bank is expected to trade between 53,218 and 55,382 until expiry on April 24. Any breakout beyond that means losses for straddle sellers and a potential short squeeze for the market. ICICI Bank's 15.7% profit jump edged out HDFC Bank's 6.7% growth, and with financials market making up 37% of Nifty 50, Monday could see the index push even higher, reports Mint's Ram Sagar. Globally, MSCI India has outperformed every major market this month, thanks to banks. FPIs have pumped over 13,000 crore rupees into financials while pulling money out of IT. So, will Nifty Bank stay in range or break out and take the market with it? Is the government planning to slap GST on high-value UPI transactions? Absolutely not, says the Finance Ministry. On April 18th, the ministry strongly denied media reports suggesting that UPI payments over 2,000 rupees could face an 18% GST, calling the claims, quote-unquote, completely false, misleading, and without any basis. There is currently no such proposal under consideration, it clarified. Some outlets had earlier reported that digital payments over 2,000 rupees might be brought under the GST net to improve tax compliance, a move that, if true, would shake up India's cost-free UPI system. But the ministry shut down that fast. It explained that GST is only applicable where there are charges, like merchant discount rate, MDR, which, by the way, was scrapped on UPI person-to-merchant transaction back in January 2020. So no MDR, no GST. The government, in fact, has been funding UPI adoption through incentives. 1,389 crore rupees in FY22, 2,210 crore rupees in FY23 and a massive 3,631 crore rupees in FY24. UPI is booming. 260.56 lakh crore rupees in transaction value this year, and India now handles 49% of all global real-time digital payments. The key takeaway? UPI remains tax-free, and it's here to grow. State-run telecom firm MTNL is in deep debt, and it just defaulted on a massive 8,346 crore rupees worth of loans from 7 public sector banks, including SBI, PNB, and Union Bank of India. In a regulatory filing, the company disclosed that the defaults, covering both principal and interest, occurred between August 2024 and February 2025. MTNL's total outstanding debt now stands at 33,568 crore rupees, including 24,000 plus crore rupees in SG bond dues and over 1,100 crore rupees owed to the Department of Telecom. Union Bank tops the list of creditors with 3,633 crore rupees in unpaid loans, followed by Indian Overseas Bank and Bank of India. Despite this financial mess, MTNL stock tells a different story. Shares have delivered 500% returns over 5 years and are still up 21% over the past year, although they've fallen nearly 15% year to date in 2025. The real question is, how long can investors stay bullish while the balance sheet keeps bleeding? For now, MTNL's financial stress is back in the spotlight, and it's not a good look for a state-backed player in a competitive telecom landscape. Amid rising global tariff tensions and a record $99.2 billion trade deficit, China is extending an olive branch to India. In an interview with TOI, Chinese ambassador Xu Fihong said Beijing is ready to open its massive consumer market to premium Indian goods and wants Indian businesses to seize the opportunity. But there's a catch. China wants India to offer a level playing field for Chinese companies in return. India's trade deficit with China surged in FY25 as imports jumped 11.5% to $113.45 billion, while exports fell 14.4% to just $14.25 billion. Despite the dip, some bright spots emerged. Indian exports of chili peppers, cotton yarn, and iron ore grew significantly. With US slapping 245% tariffs on Chinese imports, Indian officials worry about a flood of redirected Chinese goods. A new import monitoring committee has been activated to track sensitive categories like electronics, solar equipment, and textiles. As China signals a willingness to engage and India sharpens its trade defense, the question now is, can both sides turn this deficit into a deeper partnership, or will protectionism win the day? SEBI wants mutual funds to double down on real estate and infrastructure. In a move aimed at boosting long-term capital into these sectors, the regulator has proposed raising mutual fund investment limits in REITs and InvITs from 10% to 20% of NAV for equity and hybrid schemes, and from 5% to 10% per single issuer, reports Mint's Neha Joshi. The goal here is more liquidity, broader investor access, and better diversification. But not everyone's cheering. Classifying REITs and InvITs as equity instruments could open doors for index inclusion and more retail participation, said Anand Rathi of Mira Money. But others warned that their hybrid nature, part equity, part debt, complicates compliance, taxation, and risk profiling. Current rules require equity funds to invest 65% in pure equities and debt funds 80% in debt securities. Overshooting with REITs or InvITs could risk a fund's classification and tax benefits. Experts say the instruments are still niche with limited liquidity and awareness, so transparency and investor education are key. If SEBI goes ahead, AMCs will need to update disclosures and revisit risk profiles. In short, it's a bold step for broader access, but not without speed bumps. That's all for today. Thank you for joining in. We're eagerly looking forward to our next Top of the Morning episode where we bring you the top latest business news. Until then, this is Nelson John signing off. Have a marvelous Monday.